Welcome to Basic Business Finance. I'm Joseph Tan. Today's topic is Structure of Financial Statements Part 2, Lecture 2, Part 3. The objective of this section is that you learn to explain different types of operating and other expenses. The outline we will touch on structure of financial statements, income statement, the different types of operating and other expenses. For a trading or manufacturing firm, a major expense is the cost of goods sold. You may ask, what is cost of goods sold? Cost of goods sold is the total cost of inventory that are being sold. So basically, when selling goods, when a businessman sells goods, okay, there are costs involved in selling these goods. So will be termed as cost of goods sold. Let's look at expense of a trading firm. We know that cost of goods sold is one major expense. The other typical operating expense for businesses may include selling and distribution expense, general and admin expense, and depreciation expense. There are other types of expense such as interest expense, income tax expense. Revenue, expenses, and profits are accounting concept based on accounting rules. They do not represent cash inflow or outflow. So it basically means that when we make a profit, doesn't mean that if you make $1 million profit, doesn't mean that you have cash inflow of 1 million. For example, under the accounting rule, sales of goods is recorded as revenue when the goods are delivered to the customer. It basically means that the business record it as revenue when the goods deliver to customer. That's the point where the sales recognized as revenue, even when cash is not received at this point. It's a normal business practice that business sell a goods to customer, sell inventories to customer, and collect cash 30 days later. This is a normal business practice. So straight away, sales is recognized as revenue when goods is delivered. Remember this, not cash received. All right. How do we classify an expenditure as an asset or an expense? This is a very important question. In accounting, you have to classify things very carefully. Expenditure in buying fixed assets and other long-term assets are not expenses. Take note, it's not expenses. When you go for the long-term assets, okay, this basically you spend money on buying a car. So this is an asset. So they are to be classified as an asset because this asset has future benefits to the business due to their long useful lives. For example, the cost paid for an office computer is not an expense because it has a long useful life. It's reported as an asset in the balance sheet. However, as the benefit of the fixed asset is used up gradually due to usage and passage time. Example, car. The value of car will get lesser and lesser as time goes by. The asset is written down. The change is counted as a depreciation expense. Depreciation expense is reported in the income statement. Remember, income statement has three elements: revenue, expense, and profit. Expenditure such as salary for staff, rent for office premises, and office electricity are normally accounted as expenses immediately. So the moment you use them up, you straight away accounted expenses immediately, as the service provided by these items are consumed in the accounting period. So basically, the rental used for this month, you consume the service, the rental service. Okay, you use the premises, so you consume the service. Okay, as a result, you got to pay for it. They will start work for you. The service provided by the staff to the business, so you can pay for them for this month's salary. So you consume the service, you have to pay for it. This will be expenses. If the rent and other office items are paid in advance, this is something different. Take note, it's in advance. You pay in advance. Okay, you not pay later, but in advance, and the service are not consumed yet by the reporting date. So basically, the service not you pay in advance, but you have not used up the service yet. Then they are accounted as assets at that time, because you have paid for it but not use it. Okay, and you are going to receive the benefit in the future. So this will be considered as an asset. Please take note, this is very clear. Okay, please do not be confused by it. For example, next year rental are paid in advance. Now paid in advance, okay, paid in advance in the current year is accounted in this year accounts as an asset called prepaid expense. Right? So this is a prepaid expense and it is an asset. It is important to classify expense and asset correctly. Let's look at one real life case. Okay. WorldCom fraud. During the year 2001 and the first quarter in 2002, WorldCom in basically telecom managed to hide how much of the expenses? Okay, A 1.8 billion, B 2.8 billion, C 3.8 billion, 4 and D 4.8 billion. What's your answer? The answer is 3.8 billion. WorldCom reviewed its 3.8 billion accounting fraud. My question, how to hide 3.8 billion expenses is very difficult. The answer is, during the year 2001 and first quarter in 2002, WorldCom classified 3.8 billion of expenses as an asset. So it's important to know that for fraud case to happen, it just simply classified the thing differently. Assets are treated differently from expense. From this real life case study, we learn the importance of classifying asset and expenses correctly. It's very important. Otherwise, fraud case can happen, and many other errors can happen too. After the fraud was exposed, the share price of WorldCom dropped tremendously. You can see from this graph. Okay. In fact, the company bankrupt after that. It is no more existent. We have come to the end of this section. Thank you for listening to me. See you soon.